This program and the associated written materials are provided for informational purposes only and are not intended and must not be taken as legal advice on any particular set of facts or circumstances. You should not act or refrain from acting on the basis of any content included in this program without seeking legal or other professional advice on your specific matter. This program contains general information and may not reflect current legal developments or address your specific situation. This program and the associated written materials are not intended as a solicitation.
My name is Mary Hevener. I'm joined by my colleagues Steve Johnson and Anna Pomykala, and we've been asked by the Beverly Hills Bar Association to explain some of the tax rules that employers can use and charities, employer-sponsored charities can use to assist employees who are affected by disasters. Certainly, preeminent among them right now is the Los Angeles wildfires that we're a lot of us have friends and colleagues. Our firm has an office in it has a lot of employees who are also affected, so we're delighted to be able to help here. I was going to explain a little bit of the background regarding some of the tax rules that are applicable, and I'm going to let Steve and Anna do a lot of this discussion with respect to the individual slides. So if you start with the first slide, I'll explain some of the tax background here supporting these various changes. We're going to discuss a code section that allows employers to provide relief payments to any people. It doesn't have to be limited to employees. It can be anyone who's affected by a qualified disaster. And that means a flood, a tornado, COVID, any particular disaster that's been recognized in the presidential declaration as being a disaster that amounts to something that would qualify for a lot of different tax relief. So it takes the presidential declaration to have a qualified disaster. If you have one, you can use Section 139. We're going to discuss leave donation programs, and I'll explain in a minute how those work. And we're also going to discuss relief through tax-exempt organizations. In many instances, large employers will set up foundations that may be able to help employees. I'm going to spend a minute before we discuss the details of the current rules on this concept of leave donations. There is an extremely long-standing rule in the tax law indicating that any worker, an employee, an independent contractor, anyone who earns money, but then wants to say, oh, don't pay me, pay someone else. Don't pay me, pay for my children's education. Don't pay me, pay something for my mother who needs money. Don't pay me, pay a church. Don't pay me, pay someone else. If an individual requests those kinds of transfers of compensation under the very long-standing tax law, all of those contributions are still taxed to the person who performs the services. Those rules were changed to a limited extent in 1990 when the Internal Revenue Service developed a rule allowing employees to donate their leave and have employers set up leave banks to assist employees who were suffering from medical emergencies. It's a very limited exception. It was expressed by the IRS in a revenue ruling issued in 1990. It was an odd revenue ruling because it did fly in the face of all these assignment of income rules, but the IRS developed it in recognition that the federal government, indeed nearly all the federal government agencies, operated these kinds of leave donation programs. And the Commissioner of Internal Revenue at the time believed it was unfair to have rules that the federal government could follow and the private sector people could not follow. So you've had a rule in place since the 1990s that permits very limited programs whereby companies can have employees assign back their vacation days and have those vacation days be transferred out to people who are in need of vacation because either they're suffering from a medical emergency or someone in their immediate family has such an emergency. Those rules were in turn expanded dramatically, first after 9/11, and then revenue rulings that we're going to be discussing today. So that's the gist of the three things we're going to be discussing. And we'll go to the next slide, and I'll let my compatriots explain some of the rules that can help people who are listening today.
I'll take over with code section 139. It covers qualified disaster relief payments. This is a heavy lifting payroll tax exclusion. It's got very specific requirements in order to be triggered, which we'll get to shortly. But the great thing about the 139 exclusion is that when it applies, an employer, or quite honestly, anyone or any entity, can provide disaster relief assistance on a completely non-taxable basis for federal purposes. The law, in terms of how it applies for state purposes, depends on the state. But it also has the benefits of being deductible to the paying employer, unlike many other types of payments for personal expenses. The statute itself came into existence shortly after the September 11th terrorist attacks, in which Congress wanted employers and the general public to be able to make contributions to those affected, and to do so to cover living expenses that were attributable to the terrorist attacks, and receive those payments on a non-taxable basis to the recipient, and then also to be able to deduct those payments from an income tax perspective of the payor. The next slide, I think, has the requirements. The requirements require, number one, that there be a qualified disaster, which is a presidentially declared emergency. It has to be announced in accordance with the Robert T. Stafford Emergency Act, but essentially it's whenever the President of the United States authorizes FEMA and other government agencies to act under the emergency authority powers the president has. And in this case, with respect to the Southern California wildfires, former President Biden declared several counties around Los Angeles to be covered within the president's emergency powers. And so essentially the first requirement of Section 139 was triggered as of January 8th and continues to exist today. I believe that the areas that were covered have expanded since by virtue of declarations that FEMA have made underneath that presidential declaration of emergency authority. But that can be figured out by going to the FEMA website, which lists counties that are affected. The second requirement under Section 139 is that the assistance is intended to cover out-of-pocket personal living expenses of the recipient. Importantly here is that they're personal expenses, so they're not business expenses that would otherwise be reimbursed on a non-taxable basis under the working condition fringe rules, which I'll talk about shortly. But they're intended to cover personal expenses, but they have to be out of pocket. So it can't be an expense that's otherwise reimbursed by insurance or by some other relief agency. But in terms of what the personal living expenses can be, as long as the assistance is intended to be attributable to sort of unforeseen additional expenses that were related to the natural disaster, then they can qualify. These can be from everything from food to shelter to clothing to medical to transportation. The assistance can't be extravagant. It can't be lavish. It's supposed to be reasonable under the circumstances. So both in terms of the amount, the length of time that the assistance may be provided, those all should be in some form benchmarked to what actual cost, benchmarked at or under what actual costs are expected to be. And then the last requirement is that the assistance can't be intended to be a wage replacement. And what does that mean? That means that if I make $100 a week, just normal times, my regular wages are $100 a week, my employer can't, and I'm in an affected area, my employer can't say, well, we're going to pay you $60 in taxable wages, and we're going to convert $40 that we would otherwise pay you into a 139 payment, because that would violate the rules. So the employer could continue to pay $100 and then pay an additional $40 on a non-taxable basis, but you can't basically recharacterize wages for taxable wages for a 139 payment. Next slide, please. Here we are. The IRS has had limited guidance as to what qualifies under 139, but I think the heavy lifting here is figuring out how to ensure that the assistance is intended to cover out-of-pocket expenses that are attributable to the disaster. So, for instance, it would be a stretch to say that I live in Palisades, and my house was fine, but I had other completely unrelated expenses that had nothing to do with the wildfire. I have expenses due to a car accident that I was in, not related to the wildfire, or escaping from the wildfire. Those certainly wouldn't fly. But I think because of the way the statute's written, and there are no regulations under the statute, the nexus between a qualifying expense and the assistance is relatively open-ended. I had a situation for a client that was located in a county affected by a hurricane in the southeast United States. And they put parameters around that anyone that works in an affected county or lives in an affected county will get some basic stipend to help them cover transportation expenses, food, or shelter, in as much as they had to evacuate because of the storm. That was a pretty basic policy. But beyond that, I said, if you have one-off questions, we can discuss them. And there was a situation where the client had a low-level sort of hourly employee who had a child who worked in the Northeast, but who had a child that was in school in an affected county in, I think it was Florida. And they wanted to know if they could get assistance from their employer to help evacuate their child from college to come home while their school was closed. It was an interesting question, and I only tell the story here because I think it really kind of illustrates the point that that was a personal expense of the employee attributable to a hurricane that closed the employee's child's school. And so in that sense, it's not completely limited to the list of items here, but also, like with anything, what's the expression that pigs get fat and hogs get slaughtered? I think coming at this from an employer's perspective with an attempt at being reasonable without being too excessive, and with having some attempt to comply with the statute in terms of the requirements in employee communications, and making sure that it's not just a cash grab, free giveaway, and really is instead intended to cover expenses that are, very likely to be incurred. I think those are all hallmarks of a 139 type of a program that can allow an employer to get assistance out pretty quickly.
One other example, Steve, that we had when COVID was the kind of qualified disaster that had been recognized as such. We had a client who had an employee called up and said that during the COVID emergency, just before the emergency, he purchased a new home but had never gotten any furniture for it. And he asked for $350,000 to furnish his house. And we said no. That's not an expense attributable to COVID. You may need to go home and live in the house, but the fact you don't have any furniture is not something that's a COVID expense. So you do have to be a little careful, but there's not a lot of checking. One other point I should make too is that since 1987, as another rule under the tax code, it's not possible for an employer to make a gift to an employee. So an employer cannot say, look, we're just trying to be generous to employees, and maybe there are things we can't give under 139, but we'll just make gifts to employees who are really hurting. Can't do that either under the code. You're just not allowed to make a gift to an employee. So that was one reason that 139 was needed. It does have generous rules, but you do have to be a little bit careful about what you're handing out.
Yeah, a few other points to make. As I mentioned, a qualifying 139 payment is exempt from federal income tax withholding, Social Security tax, Medicare tax, and federal employment tax. In California, 139 qualifying payments are exempt from state personal income tax, and therefore exempt from state personal income tax withholding. But according to the California EDD, 139 payments are still subject to state level unemployment taxes and for short-term disability insurance payments.
And that would be, of course, Steve, if they came from the employer. If an employee happens to be getting funds from another source, like a charity or something like that, I I'm not sure how the EDD can say that you have any kind of employment taxes related to it, but certainly if an employer is handing out this, the employer has to be careful to value what's being handed out and then apply these California taxes. Most other states don't do that, but California is a little different.
I agree. A couple other points. The section 139 does not have any anti-discrimination standard that would prohibit making payments in favor of highly compensated employees to the detriment of non-highly compensated employees. That rule doesn't exist. That said, I will tell you, I've been in plenty of meetings with our labor and employment colleagues that show real concern about an employer adopting an assistance program that disproportionately benefits certain groups of employees, whether it's within the same sort of pay range or even if it benefits higher end, executives to the detriment of lower end. And I think the reason is that that's potentially it's just bad. It's a bad optic, but also I think there's worry that it could open up the paying employer to some kind of a discrimination type of a claim. The last couple of points I have on section 139 payments, I think it's still important to keep good records in terms of how an employer sets the amount. How are you benchmarking? And I'm not here to say you have to hire consultants or experts to come in and say, how do we justify a $500 payment or $1,000 payment or whatever it might be. But I like to think of it in terms of, has anybody done any kind of basic research about, what a reasonable price is to get a hotel room for a week, 100 miles away? Or has anybody looked at what it would cost to, just benchmark basic, a basic change of clothes or a wardrobe, not a full wardrobe, but basic amenities? What are the prices of, car rentals look like in the meantime? Childcare, certainly. So I think there's a lot of ways to get there. It doesn't have to be specific to any actual expense. I think as long as it's, generally in line with what expected personal living expenses are going to be. The last point I'll make is that in my experience, in situations where employees are affected by natural disasters, oftentimes what they need is cash and they need it quick. And so the idea about gift cards, or we'll have an application process, submit receipts, quite honestly, in the wake of a disaster, oftentimes the best thing an employer can do is pump money into affected employees' bank accounts through the payroll process, essentially. So direct deposit into employee checking accounts. If that's done while it gets money there more quickly, employers need to be aware and be mindful of how those payments are coded for payroll tax purposes, so they don't inadvertently get lumped in with taxable wages, or they don't inadvertently fail to get picked up for state level taxes that may apply. We can go to the next slide. It pretty much said all I have to say about 139, and I can turn it over to.
So working condition fringe benefits are not limited to disasters, but they're very useful insofar as employers are trying to help their employees also to get back to work. These are essentially, this can be cash payments or reimbursements for property or services that could be deducted as a business expense, essentially. And during COVID, when people were forced to work from home, we advised employers on how they could help employees get, extra computer equipment. Maybe they didn't have to work at home and didn't even have a desk, and so on. So here, in the context of a wildfire, we have some folks, if they lost their house, they might need access to a temporary workspace. They may need that office equipment. They may need new computers or accessories. They may need cell service or internet service. Only the part of whatever expense that is that's attributable to business use can be excludable from employee income. which means it wouldn't be subject to income tax and FICA. I think it's safe to assume in the circumstances that I've seen on the news that if people have lost access to their homes and to these materials, these items could be considered 100% business use. On the next slide, so that was the last slide. If you can move, what's also helpful to know about the working condition fringe is that this is not limited to W-2 employees. It's a broader list of workers who can receive a working condition fringe. It's not only your current employees, it's your partners, it's your board members, and it's your independent contractors.
And by the way, it's not a term that we made up. It's actually in the Internal Revenue Code, that the benefits that a company gives to individuals working for it, or a partnership gives, any entity gives to service providers, can be a working condition fringe if you meet the tests for exclusions that are outlined in the code and the reg. It's not a commonly recognized term. You don't see it in the news. It's not something Siri even might know, but it is certainly in the Internal Revenue Code and provides an exclusion from income and also from payroll taxes.
Steve, do you have anything else to add on working condition fringes? We went over these expenses. This is a circumstance where you would want your employees to keep records of receipts, but I also had a conversation with an employer last week whose IT department, for example, was prepared to send out packages of computer related equipment and so on, because getting supplies in the affected area might be difficult.
I would just simply add that the 139 qualified assistance exclusion and the 132A3 working condition fringe exclusion fit sort of neatly together, in that 139 covers out-of-pocket personal expenses, whereas the working condition fringe covers out-of-pocket business expenses. And so they don't have any potential for overlap. And yet there still are two separate ways in which an employer can provide some kind of assistance in light of a natural disaster. Note that the working condition fringe doesn't just apply to natural disasters, though. It just happens to potentially be relevant right now, as companies are, like Anna said, are scrambling to get materials and supplies to employees who otherwise aren't able to come into the office or access them from home.
So I just to pause to let our audience know that there is you do have the capacity to ask questions in the Q&A. I don't see any yet.
And certainly I'll just add that anyone in the audience can reach out to the Bar Association with questions, and they will forward them to us, or look for Mary Hevener, Anna Pomykala, or Stephen Johnson at Morgan Lewis. You can find our email addresses online on the firm's website, and feel free to send any questions you may have about this presentation as well. Next slide. Handy, you're on mute. I think no, you're not on mute. Handy, you want to pick up where you left off with respect to leave donation?
Yeah, this was the revenue ruling I mentioned at the start, that the IRS since 1990 has had this odd exception from the general rules prohibiting people from assigning income and avoiding tax on that assigned income. Starting in 1990, the IRS allowed employees to deposit their annual leave in a leave bank, and then the employer would hand the amounts out to employees who suffer medical emergencies. You have to be careful, because it needs to be a medical condition of the employee or a family member of the employee that's going to require the employee to take a prolonged absence from the job, and is obviously in that event would have a substantial loss of income to any employees that don't have paid vacation days and paid PTO left. So in that kind of a situation, the employer can accumulate leave in a leave bank and then hand out additional leave days, paid leave days, to employees who need to take paid leave. Employees can apply to the employer for the donated leave. Individual employees aren't supposed to select the recipients. So you as an employee are not supposed to say, well, I'll give my leave days, but only if you're going to give it to my friend here. You have to have the leave collected for employees and then leave it up to the employer to distribute the leave as the employer sees fit. And the employer can set rules as to the amount of days and PTO days that can be donated and rules on how leave could be granted. For example, if you have a top executive who's paid an enormous amount translated into hourly rates or daily rates, you may need to have the leave bank adjust what's happening so that the leave days may be worth more when a top executive contributes leave days. Not all companies do it, but it's certainly something that can be done if the employer decides to make adjustments and changes in leave days that are donated. And additional paid leave for the recipient is paid out at the employee's normal rate of compensation because it is handed out as a PTO day. So, and when received by the employee would be simply additional compensation. So it's not taxed to the person who surrendered the leave if under Rev Rule 90-29. It is taxed to the employees who received the leave days. That's sort of a general overview of the revenue ruling. There are numbers of what are called private letter rulings that the IRS has issued with under this revenue ruling 90-29. I'd say 2/3 of them are bad news for the companies that got the ruling. The IRS says, no, you didn't meet the rules. No, you've allowed the leave to be taken by people who don't have medical emergencies. No, you've allowed leave to be handed out to people who really don't qualify. So you need to be very careful because this is something that the IRS does monitor, and they have upon at least a dozen occasions issued rulings that have warned employers not to set up the leave banks in a way that operate in too generous a fashion. Next slide. And now we're going to talk about the employer deposits into an employer-sponsored leave bank. This is a different revenue ruling. This is one that was followed in a series of very short IRS notices after 9/11, for example, but then the IRS formalized the guidance and issued notice 2006-59 that provides different rules than those that apply under the 1990 revenue ruling because they allow the leave to be donated not just for medical emergencies, but for employees who have severe hardships on account of a disaster, particularly on account of a presidentially recognized disaster where the employee has to be absent from work. So unlike all the prior discussion of employer donations that go for personal expenses, this is a program that allows employers to let employees donate leave to each other in the wake of a disaster. And then again, the donors of the leave are not taxed on the leave they donate, and the recipients of the leave are taxed on the leave they donate, but it's not it works so it's not taxed twice, which is terrific. The donee, the recipient of leave, is subject to income tax withholding and FICA tax on the donated leave, but the donor doesn't have any tax. If you don't have a presidentially declared national disaster, or if you don't have a medical emergency, you need to be careful because these leave donation programs don't work. Next slide, and I think Steve, you or Anna are going to take over here for some of the caveats, so I'm not the only one talking.
I'm not aware of that, but certainly I can. The couple points that I want to make, and Andy, help me remember, it's relatively rare for the IRS to give guidance that says the donating employee can actually claim a charitable contribution for the leave. That's just kind of depends on sort of administrative prerogative. There isn't any kind of standard that says it kicks in and it has to happen at any certain point, as I understand the rules. Are you aware of what the substantiation rules are in instances when the IRS has recognized the ability for donating employees to be able to claim a charitable contribution deduction?
Well, and that's actually not a leave donation, Steve. I mean, I think we were first talking about leave. And if you're donating your annual leave and you have annual leave to donate, then it works pretty well because the donor doesn't have FICA and the donee does. What the IRS has done in the case of various individual disasters, and it's done this a couple of dozen times is to let people just write checks and contribute to the charity. It's enormously helpful when the IRS has allowed these kinds of charitable donations of cash, because not everyone has the PTO to donate, and not all people want to necessarily donate their PTO. They're happy to dig in, write a check from their checkbook, but they don't want to necessarily give up PTO. So on the occasions when the IRS has announced charitable donation program, and they have not done it for the California wildfires, but when they do announce it, it allows people just to take out their checkbook and write a check and give the check to a charity. And assuming that the charity is then in turn helping people afflicted by the national disaster, the donor gets a charitable deduction, which is terrific. And in the case where somebody's writing a check and they're actually donating their leave, they're going to not be taxed on the leave, and there's a real incentive to try to give away your income and assign your income, because then you get the FICA tax break as well. They just haven't done it here. I was tremendously hopeful that Biden would, in one of his last acts, announce that you could have these kinds of charitable donations to charities, but it wasn't done by the IRS before Biden left. And I frankly think with all the other stuff facing the Trump administration, it's not too likely that he's going to announce a charitable donation program at this point. There had not been one announced by the Trump administration for any California wildfire or flood during the Trump administration. And I doubt that in the early days of the new Trump administration, there's going to be a big announcement that's going to allow these kinds of charitable donations. But for the leave donation programs, you have to have PTO to be able to donate it. The other problem, and I'll start with the slides, is that the employer has to track the donations if a tremendous amount of PTO is donated and it isn't used. In my experience, it's extremely unusual for an employer to collect these PTO donations and then have them not be used. Most employers keep the period for distributing the donated leave open for relatively long periods of time. So there isn't a big need for an employer to track and then return the PTO leave to the individual donors in proportion to the leave that they donated. It's certainly a requirement that that be done in Notice 2006-59, but I haven't seen that happen. Even though we have seen tremendous amounts of PTO be donated in situations like the one that's unfortunately afflicting Los Angeles, there are a tremendous number of people who need to leave as well. So I doubt at this point that you're going to have a situation where the leave remains unused and has to be returned to the donors. The idea of having,
so on that point, I would presume that companies that do operate leave banks have them open-ended to say you can donate for medical purposes as necessary or as needs arise, or for natural disaster as needs arise, and it's not limited to this disaster or to this period of time. They tend to be literally banks that are there until they're utilized.
And that's by and large why you don't see any companies turning around and returning the leave to the donors.
How common is employer matching for leave donations? For every hour that somebody donates of their leave, the employer will match in like kind whatever that hourly rate would have been to the bank or to some other charity, some other way to get assistance out into the affected community. Is it relatively common?
I've certainly seen it. I think most employers will, just as with any matching program, they'll put limits on the match. They'll say for the first day you give or 2 days you give, we'll do a match. It usually doesn't extend beyond that. I think employers also wanted to see how many people were going to be donating PTO. But I certainly have seen it. I've also seen it coupled with a cap on how much is being matched.
Right, because I guess related, the employer still gets to claim an income tax deduction for the leave when it's utilized, because it's essentially a taxable wage expense. But I would presume
they will
that
claim the same deduction for the instances where the IRS has allowed cash to be given to charity. I mean, the employee isn't taxed on the donation. It isn't taxed on the donation, but the employer is going to get an actual deduction. They didn't even limit it to a charitable deduction in the instances where they've allowed these contributions to charity. We just haven't seen it for these wildfires. They've limited their relief only to donations to these leave programs, and that's it. We're not talking specifically about cash contributions to charity. I think luckily for everyone, the Code Section 139 exclusion coupled with the working condition fringe means that the recipient, may not necessarily be taxed on a lot that's handed out. The other benefit of cash contributions to charities, the charities can give subsistence funds. They can just hand out money to people who are in need of it without necessarily meeting the conditions of 139 or the working condition fringe. We just haven't seen any announcement from the IRS, and I don't think we're going to see one here that's going to allow these kinds of leave donations to charities.
If I can interject, we have a relevant question in the comments. The question is, does the working condition fringe benefit apply to volunteers?
Yeah, it does. They actually, I actually worked with that because it was pretty clear the volunteers didn't have any profit motive, but there's a specific regulation, I think it's 1.132-R, that recognizes that volunteers are able to get working condition fringes. The IRS spent quite a deal of time on that in 1986 and 7 when it was developing these regulations.
Yeah, it's 1.132-5R, and you're right.
Oh, sorry, -5R.
That's the working
I left the 5 out.
Yep, regulation.
I got the R right though.
Yep.
And so we have a second question that asks, if only some employees are affected, can you only help them? And so in both both under 139 and for the leave donation program, you'll want to make sure that someone is receiving funds because they've suffered some sort of a hardship or incurred expenses, unexpected expenses with respect to the specific disaster. And that may not be everybody in your workforce, of course. And so getting some kind of a written statement at some point is, that certifies to that would make sense.
Well, I'm just trying to right size the assistance, right? You don't want to say everyone in our, national company gets a 139 payment because of wildfires in California, including employees in Massachusetts. That makes no sense. But right sizing it to where we say all employees within the affected account, within the counties that are identified in the presidential emergency order as a starting point, but then further, you have to have some sort of proof that you were affected by, it could be even more granular in terms of, by address or by providing some kind of a certification, proof of actual incurring an expense. So there are ways that certainly it could be made to be smaller, but you don't want it like Goldilocks and the three bears, right? You don't want it to be too big or too small, because then you've provided assistance to people who don't need the assistance, so they have a windfall, or you've not helped people that were otherwise in a position to need the help in the first place.
And relevant to your point, we had an employer ask some questions last week about how to do they have to give the same type of help to everybody? And the answer is no, based on what we just described. And then how can they modify their plan very quickly? And their plan had been drafted years ago and set a dollar amount that for rent assistance, for example, that I'm sure was out of date in terms of what the market demands right now, and had listed in that plan. And they, instead of revamping the whole thing, added language to say, if you have if you have requests specific, to your situation, please let us know.
To this point, I will clarify that under section 139 and under the 132 working condition fringe rules, there's no requirement for a written plan. There are other code exclusions that do impose a writing requirement. 139 and the working condition fringe do not, for reasons that we've explained, to avoid confusion, to avoid abuse, to have, and, to basically be documenting for potential audit defense file. There are certainly reasons why putting a policy in writing makes a whole lot of sense. But whether or not there was, an outdated plan that was in writing doesn't affect technical eligibility or availability rather of either of these exclusions. Mindful of kind of where we are on time, do we want to maybe move forward to the next slide? Handy, do you want to go with
Well, I mean, again, this is another thing that many companies do to set up their own private foundations or even public foundations. A lot of companies also orchestrate relief through charitable organizations by making donations to charity. So they announce to their employees that they're willing to collect the monies and to donate them to charity. This is more commonly an area where an employer will also match donations to charity. I've seen that happen more often than with donations of leave days. If you're going to set up your own charitable organization, you have to have a class of beneficiaries that large enough or indefinite enough to constitute a charitable class. Frankly, I think for employers in the Los Angeles area, it's very likely, unfortunately, that they're going to have a class of people that are going to be large enough to be a charitable class. Also going to meet the second condition that you have to select the recipients based upon an objective determination of need. As Steve said earlier, you can't just throw out money. You have to be sure that somebody really did lose the entire house or have a house nearly destroyed in order to be able to hand out the charitable funds. And you have to also be sure that the benefit to the employer is incidental, that most of these foundations are run through independent selection committees that make sure that the money is going out to deserving recipients for deserving reasons. Next slide. And as I said before, the charity usually solicits contributions to employees. The board often includes rank and file employees. And the other point is that it's very common for employers to add matching contributions to incentivize employees to give. We've seen that happen a lot. Next slide.
Also,
Okay, I'm sorry.
because of the sort of technical requirements that Hanny just mentioned, going the employer charity route is not preferable when Section 139 is otherwise available because it has many strings. I'll also say when it comes to charities, there are some concerns that our tax exempt colleagues are always concerned about to make sure that there isn't any potential for private inurement that the charity is paying out in favor of certain select employees or executives. I have been witness on email traffic that based on where the wildfire started and that they were often in more affluent areas, more affluent suburbs of Los Angeles, that there were charities or company charities in place that were worried about providing assistance through their charity because of how it could disproportionately affect the sort of top upper management and executives more so than lower level employees who may be in different parts of the city. I think at this point in where the wildfires have spread, I don't know that that's quite as much a concern, but certainly another thing to be mindful of when going the foundation route. Also, a foundation can't be stood up overnight. That's been another problem too. We've had clients that would consider going the foundation route, but it's one of those situations where if the foundation isn't already in place, isn't already established, doesn't already have the tax exempt blessing from the IRS and state departments of revenue, it's not something you can do overnight to then be able to start providing assistance through a foundation. So it takes some foresight and some planning. That said, I get a sense that there are a number of companies now that found that they did not have a company charity in place and are looking at the wildfires as an opportunity to be prepared the next time there is some kind of natural disaster. Next slide.
That's it.
Here's where we are. Here's how you find us.
All right, and maybe we just give a moment or two for our attendees to submit any questions. Please use the Q&A function.
In the meantime, I do want to say that we're very grateful to the Bar Association for giving us this opportunity to speak today. And that we sincerely send our sympathies and our support to everyone who's been affected by these horrible wildfires.
All right. I don't see any questions in the Q&A for our attendees. If you have any questions after the webinar is concluded, their contact information is available in the packets. Please check the Zoom chat if you haven't received the packet, or feel free to reach out to us at help@bhba.org. Thank you so much for your time today.
Thank you.
Thank
Thanks,
you.
Ann. Thanks, Steve.
This program and the associated written materials are provided for informational purposes only and are not intended and must not be taken as legal advice on any particular set of facts or circumstances. You should not act or refrain from acting on the basis of any content included in this program without seeking legal or other professional advice on your specific matter. This program contains general information and may not reflect current legal developments or address your specific situation. This program and the associated written materials are not intended as a solicitation.